Do you ever wonder how to build your own portfolio with the Vanguard index funds and ETFs in your taxable brokerage account to save for your early retirement? I have a Vanguard portfolio that someone sent me and I want you to be the judge of it. And let me know in the comment section down below what your index fund allocation strategy is. And this person used the rule of 120 because he has a higher tolerance for risk, and which means 120 minus your age, and that's your stock allocation. Some investment pros use the rules of 110 or 100, but again, it's really up to how much risk you want to be exposed to in the stock market. For example, I'm 35 years old, and if I subtract it from 120, then that's 85% stocks and 15% bonds. Simple, right? However, I don't personally invest in bonds until I reach financial independence or when I become more risk averse in my 50s or 60s, but that's just me. I know I bonds are really popular right now with high inflation, but it's still limited to $10,000 annually, and I believe stocks will still do better in the long term, and by no means this is financial advice. If you're brand new to my channel, my name is Sai and welcome. So in this video, I'm going to talk about the different investment allocation strategies with the target retirement funds and index funds and how this person diversifies his Vanguard index funds and ETFs in his taxable brokerage account. And I would love to hear your opinions on the allocation strategy. Also, I just noticed that I had 1,000 subscribers on YouTube, and I want to thank you all for being my loyal subscribers. And I'm also about to reach 1,000 on Instagram and over 4,000 followers on TikTok, which is more for my travel content, and I will put my link tree in the description below. There's also a lazy way to invest, and that's called a target retirement fund, and there's nothing wrong with that. The target retirement funds are also known as invest and forget for the average investors, but picking the wrong target date funds could cost you tens of thousands of dollars in the long term. When you look at the list of target retirement funds on Vanguard, you need to first figure out what year you're going to turn 60 years old, because at 59.5, that's when you're typically eligible to withdraw from your retirement accounts like 401k, TSP, and IRA, and you want to be more risk averse by preserving your capital when you're close to your retirement age, right? For example, I'll be 60 years old in the year 2046, then the Vanguard Target Retirement 2045 fund would be the right choice for me because this mutual fund is exposing my risk to the market based on my current age. This fund right now has 85% stocks, 13% bonds, and about 2% cash. And it's basically using a rule of 120, sort of, right? So next year, I expect this fund to change its allocation to probably about 83 or 84% stocks, 15% bonds, and 2% cash. By the year 2045, I would expect the fund allocation to become more like 35% stocks and 65% bonds and cash. Also keep in mind that the allocation changes when we experience a correction or a bear market. At the beginning of 2022, this target retirement fund was at 88% stocks and 12% bonds. Since the overall stock market is down nearly 20% year to date, the equity allocation has reduced to 85% stocks. And that's probably because most stocks are down 20% or more this year, right? So naturally, the allocation will be reduced as well. So the downside of this target retirement fund is that it's not being aggressive enough by investing more into stocks when they're in a downturn. Investors should be buying more when the stock market is bleeding instead of during the expansions. So the classic buy low, sell high concept should be common, but nobody's really doing that right now. People are doing the complete opposite by selling low and buying back high because they're being fearful of the economy. I'm also not a fan of the target retirement fund because I don't have any control over the portfolio allocation in the mutual fund like small, medium, and large cap stocks, or the exposure to certain sector stocks. The MIT also did an extensive research and study on the target retirement funds and why they're not appropriate for most investors, and I'll link their study in the description below. By the way, you can get our free financial independence resources by visiting firesidechat.com/contact. You can also check out the Fireside Chat shop if you're looking to start your own YouTube channel, and I have all of my equipment at firesidechat.com/shopping. When it comes to picking index funds or ETFs, you need to consider your exposure to large, medium, and small cap stocks. Large cap companies are more stable and mature businesses, and their market cap range is at least $10 billion. Mid cap companies are worth about $2 billion to $10 billion. Small cap companies are worth less than $2 billion. Smaller companies are much riskier because of their volatility in the market. but some of those companies do eventually become mid cap and then large cap. Let me draw you this chart to give you a better understanding of the risk and returns. So on the left side, I have the market returns, and on the bottom side are risks. Let me show you this nice little curve right here. And the first one is your government treasuries or bonds that give you a lower risk and lower returns, right? If you invest all of your money in the next 10 years into bonds, then you're probably just looking at a 2.5% return on average, but you're also preserving your capital from getting hit 10, 20, or even 30% downturn in the market. The next one is large cap blue chip stocks, which are more established companies. So you're risking a little bit more to get higher returns, and the chances of these large companies going bankrupt are really low, but there's still a small risk. The mid cap and small cap companies are even higher risks, but they have the potential to make higher returns. So within this portfolio, I like to be exposed mostly to large cap and take a risk on medium and small cap stocks to have a higher return because I'm still young and I can take the 20 or 30% hit in the short term. However, if you're about to retire or in retirement right now and you don't have a lot invested, then taking a 20 or 30% hit to your portfolio could significantly impact your retirement income, right? So now let me show you this Vanguard taxable brokerage account, and you can submit yours by emailing me at hello@firesidechat.com. The first one is the Vanguard S&P 500 Index, ticker symbol VFIAX, and it's about half the portfolio at 50%. Initially, when I started investing back in 2016, I just threw everything into this index fund, and the market performed really well, until 2022. This fund is down about 17% year to date, but it's performed a 13% annual return for the past 10 years, which mirrors the performances of the S&P 500 Index. And if you remember the risk reward chart I showed you earlier, this fund would be in the large cap equity risk return category. The second one is the Vanguard Information Technology ETF, ticker symbol VGT. At the beginning of this year, this ETF was almost at 20% of the portfolio, but since it's down almost 20% year to date, the allocation was reduced to about 12%. And during the 2022 bear market, the tech stocks especially are getting hit pretty hard. This ETF only invests in tech stocks like Apple, Microsoft, Nvidia, Cisco, and Adobe. So it's considered a very aggressive, high risk type of ETF. I like this ETF because during the bull market run, it really pays off. And despite what you're seeing with a negative 24% return so far, this ETF has performed an 18% annual return for the past 10 years, which has outperformed the S&P 500 index. The third one is the Vanguard Healthcare ETF, ticker symbol VHT. This one has about 10% allocation in this entire portfolio. Invest primarily in the healthcare sector like Johnson & Johnson, Pfizer, United Health Group, and this ETF is down 11% year to date, but it's performed a 14% annual return for the past 10 years. This ETF tracks stocks not just in healthcare, but the medical products, services, technology, and equipment. I'm personally a fan of this ETF because it exposes to a sector that doesn't necessarily correlate with other sectors. And let me know in the comment section down below what your thoughts are on the healthcare ETF. The next ETF is the Vanguard Utilities ETF, ticker symbol VPU. And this one also is about a 10% allocation in this entire portfolio. I like this ETF because it has a 3% annual dividend yield and it performed a 10% annual return in the past 10 years. It tracks specifically in utilities like electricity, water, gas, and other independent energy companies that provide energy and needs to the consumers. And I like this ETF because, like healthcare, it is a needs-based ETF that even during a recession, people are gonna need water, electricity, and gas, right? The next ETF is the Vanguard High Dividend Yield ETF, ticker symbol VYM. This ETF is more of an income-based investment that tracks dividend-paying stocks, and it tracks the investment performance of the FTSE High Dividend Yield Index. It takes up about 15% of the allocation in this portfolio. It's performed almost a negative 8% return, but it's performed a 11% annual return for the past 10 years, not counting the dividend reinvestment. And in full disclosure, I do own this ETF in several of my investment portfolios. Let me know if you enjoyed this video so far, and I'll make a future video on Fidelity and Schwab portfolios. By the way, if you need help with your personal finances like budget, savings, and investments, You can schedule a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. So to sum everything up, he has 50% or half of his portfolio in the S&P 500 index fund, 10% in healthcare, 10% in utilities, 10% in tech, and 15% in the high yield dividend ETF. I personally like his portfolio because he's exposed to several sectors and they don't necessarily perform the same as one another. If you want to be even more aggressive, then Vanguard has the small cap and medium cap ETFs and index funds like Russell 2000 Growth ETF or S&P 400 Mid Cap ETF. I strongly encourage every one of you watching this video to check out the Vanguard list of index funds and ETFs. They have other sector ETFs such as real estate, consumer discretionary, communication services, financials, and consumer staples. The only one that's up this year is the energy ETF at 32%, but it doesn't mean that that's the only ETF you should be investing in, because if you look at the 5 or 10-year performances, this ETF has only done a 3% return every year. And if you scroll up, you can choose ETFs based on their market caps, and keep in mind that the higher the risk, the higher the reward or losses. So when the market does really well, then the reward is higher. But when the market does terribly, it could really bring the value of your portfolio down. If none of this makes sense to you and you don't feel like doing the work, then you have the option to invest in a target retirement fund that has the automatic allocation until you turn 59.5. If you're brand new to investing, I want you to take the time to truly understand the differences between ETFs and index funds before you make any financial decisions. You should never invest in something you don't understand. Take the time to invest in your financial education. And if you want to know more about how to invest to achieve financial independence, be sure to check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.